How are you there?
Good day, everyone. Welcome to today's session on Principles of Auditing. This is our third lecture in the series. So if you haven't watched the first two lectures, I advise you look at them before coming to this video, really, because it's a continuation of that lecture. Today, we're going to continue by speaking to the impact of laws and accounting standards on auditing. So as auditors, our work is guided by laws and certain standards, especially of the country in which we operate as auditors. So we're going to speak to some of these laws. And one of the laws we're going to speak to really, it's the Companies and Allied Matters Act. That's if you are a company operating in Nigeria, but for companies outside Nigeria, it would be, for example, in Ghana, it would be the Companies Act. So the Companies and Allied Matters Act, it's basically the statutory law that guides auditing of companies that are registered in Nigeria or in a country, in the case of Companies Act in another country. And so for every company, it has to be registered. And you do that registration with the Companies and Allied Matters Act, really. The Act is in charge of that, provides regulation to that. So basically, if you registered, CAMA is important, you need to comply with CAMA. However, your industry, the industry you operate in can also have some regulations that you need to comply with. For instance, if your business or the company you're auditing is a bank or other financial institutions. So by other financial institutions, we basically mean other companies that are not banks, but offer financial services. So we could have FinTech, for example, it falls under here. So if that company is in this class, you also need to ensure that your audit complies with the Banks and Other Financial Institutions Act. And if you are an insurance company, there is a law as well called an Insurance Act. So CAMA is applicable for all companies as long as you're registered. And then there are what we call sector-specific regulations. So the sector-specific regulations is where you have the BOFIA and the Insurance Act. So these different laws, they provide regulations on how auditors can conduct their audit, how they can carry out their audit. They also provide laws and regulations on what auditors are to check, or which books of account they are meant to check, the applicable financial statements. So you have that information there. And so you also have these regulations providing information on the nature of the relationship that an audit firm should maintain with the client. What relationship is acceptable? What level of relationship is not acceptable? So let's look at some provisions of CAMA, beginning with responsibility of management. This regulation is actually similar if you look at other company acts as well. So what we have in here is also applicable to most other countries, really. So Schedule 2 of CAMA basically requires every company to keep proper accounting records which shall sufficiently explain and show the transactions of the company. So what that basically means is that if you have a transaction, say you have your financial statement, you have an asset, a debit for say 40,000. Now your accounting record should be able to explain specifically what this debit is for. So if, for instance, you get an alert on your account that's at individual account level, we should be able to say, okay, what is this debit for? And what is the evidence to support this debit? So that would be, if buying an asset, you need to see the physical asset. You should be sure that you have that available. You need to see the receipts, the contract, the invoices that were used to consummate that transaction. And now such record, for you to say that record is sufficiently kept, it should be such that it will disclose with reasonable accuracy at any time the financial position of the company. That's one requirement for you to say that the record is being properly maintained. It should give you accurate position of the company. Second criteria is that it should enable the directors to ensure that any financial statements prepared under it or using it are reliable and accurate. So those are the two criteria that companies need to put in mind in meeting this requirement for maintaining proper books of account. So as a company, you basically would have 5 classes of transactions generally. So you basically have your expense, you have your income, you have your assets, you have your liabilities, and you have your shareholders' equity. So all these different class of transactions, you should have sufficient information, sufficient records to explain these transactions as they are consummated. So you need to have your different receipts, your different contract document as well. Now, having spoken to the responsibility of management as regards keeping proper books of account, CAMA also discusses the requirement for auditors, speaking to the scope of the audit function. So what are the responsibilities of auditors as spelled out in the law? So the requirement is that auditors of a company shall make a report to the members on the account examined by them and on every statement of financial position, the statement of comprehensive income, statement of changes in equity, and on all group financial statements, copies of which are to be laid before the company in a general meeting during the auditor's tenure of office. So basically, it means that auditors were to make a report, which were to express our opinion on the accounts examined. So that's the requirement. Express opinion on the accounts that you've examined. That is a key requirement for auditors. And these accounts examined will generally fall into financial statements such as your statement of financial position, your statement of comprehensive income, your statement of changes in equity. Now, for companies that are called public companies, so public companies will basically be companies that are listed on an exchange, or companies whose activities significantly impact the public. They are required to have this report laid before its audit committee. So what's the composition of this audit committee? As per CAMA 2020, the audit committee should comprise of 5 members. And this is made up of 2 non-executive directors and 3 representatives of the shareholders of the company, with at least 1 member being a professional accountant. Please take note of that requirement. So you should have 5 members, 2 non-executive directors, 3 shareholders represented. Requirement is that at least one of these must be a professional accountant. So that is a key requirement of CAMA 2020. That did not exist in the CAMA 1990. So if you're still using the old study pack, you're going to have in there 6 representatives, equal number of directors and equal number of shareholders. But in CAMA 2020, that has changed, and this is the requirement. 2 directors, 3 shareholders representatives, and at least 1 professional accountant. So what are the responsibilities of the audit committee? Now, the responsibility of the audit committee is always documented in this document called Articles of Association. So the responsibilities, the rights, the powers of members of the audit committee, you would always find it in this document called Companies Articles of Association. And some of the objectives and functions of the committee would include: 1, to ascertain whether the accounting and reporting policies of the company are in accordance with legal requirements and agree with ethical practices. So you want to be sure that all regulation, all requirements of the law and ethical principles have been complied with by the company in its accounting and reporting practices. They also want to review the scope and planning of audit requirements. So that's part of the responsibility. Review the findings on management matters in conjunction with the external auditor and departmental responses thereon. So if the auditor in the course of his review has pointed out some issues, so they want to review management and the response from the management and department to be sure that it aligns with what they would really want it to be. A fourth function of the audit committee is to review the effectiveness of the company's system of accounting and internal control. So that's another one. The fifth function is to make recommendations to the board with regard to the appointment, remuneration, and removal of the external auditors of the company. And this function of the audit committee is very important for the auditors because it ensures and it safeguards auditors' independence. So please take note of this function of the audit committee. So, because if we were to have management, those in charge of the day-to-day running of the company, to appoint or to determine the remuneration and to remove the auditor, there is this risk that management would want to influence auditors' decision, and auditors will not want to offend management because they want to keep that engagement, they want to continue making money from that job. But because there's an external party, the audit committee doing that, that safeguards their independence. The sixth function of the audit committee is to authorize internal auditors to carry out investigations into any activities of the company which may be of interest or concern to the committee. So that's another responsibility of the audit committee. So if you take note of these different functions, you notice one underlying theme around them. You would see something here. It says review, 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 make recommendations, ascertain. So that basically means that for an audit committee, the primary responsibility is monitoring. So that's basically their primary responsibility. That's a likely question in exams. Their primary responsibility is monitoring. So they want to monitor what is going on in the company. They want to monitor the activities of the management to be sure that they are carrying out their responsibility as stewards in the right way. But for management, their function would basically be that of execution. So the audit committee would not execute, they would monitor, make recommendation, and their management will go ahead with execution. So those are the functions of the audit committee. They play a very important role in safeguarding auditors' independence. Let's look at some other key provisions of the Companies and Allied Matters Act, which is very important for our role as auditors. So let's look at some of these provisions. So one of the provisions of the Companies and Allied Matters Act is that it shall be the duty of the company's auditor in preparing their report to carry out such investigations as may enable them to form an opinion. So as auditors, our job is to express our opinion. That's a recurring theme, express opinion. That's our job, that's our role. So in expressing this opinion, you should carry out any investigation, any review, any check that you think is necessary to enable you form that opinion. That is one key provision of the law. The opinion should be based on a detailed review, which you would have undertaken. Now, after you've undertaken your review or their issues as auditors, the second provision of the law is that you need to state matters as they are. You need to state matters as they are. So if you conduct a review and you find out that the financial statement does not show a true and fair view of the financial position of the company, you should do what? State the fact. Now, if in the course of your audit, you determine that you meant to do a review from certain branches, but you've not received those records from the branches, you should not then assume that, oh, because I've not checked, I've not found anything bad, so the financial statement is okay. No, you should do what? You should state the fact. So if there are anything that would prevent you from expressing your opinion, you should state the fact. If the financial statement in the course of your review, after conducting your review, determine that the financial statement are not in agreement with the accounting records and returns, you should do what? You state the fact. Now, where the financial statements do not show a true and fair position, and you have to state the fact to the contrary, such a financial statement is said to be a qualified financial statement. Oh, so you qualified, or you could call it qualified audit report. That is very important for auditors as well. Qualified audit report. Qualified audit report is issued where, in the auditor's opinion, the financial statement does not show a true and fair view. We're going to discuss the various forms of qualification in the course in a later section. Now, another requirement of the law, it's provided by CAMA, is what is called a right of access. A right of access. So as auditors, you have a right to any records, any detail, any explanation that you feel is necessary, anything that you think is necessary for the performance of your duty as an auditor. Please take note of this word, necessary, for the performance of the auditor's responsibility. So what it means is your role is financial. You're doing financial review. You're reviewing anything that has to do with that impact on the financial statement. So you have access. You can't have access to. You can demand for it. Outside that, you do not have that authority. But if it relates to that, you should have that right. So the company cannot tell you or decide for you what to give you and what documents not to give to you. You have a right to demand for any document, any record you think is required to conduct your audit. Now, the fourth provision of the law which you need to consider is the auditor's duty to consider whether the information given in the director's report for the year for which accounts are prepared is consistent with those accounts. And if they are of the opinion that it is not, they shall state the fact in their report. So basically, in a company's annual report, what you call annual report, if you log into or you check any company's website, especially companies that are listed on the exchange, you would find their annual report there. So when you open that annual report, you always have the financial statements. In addition to the financial statement, you have some other notes, some other explanation. And one of those extra articles in the annual report is what is called the director's report. So in this report, the directors would explain the figures in the financial statement. They will explain activities that happened through the year, certain things that would have impacted on their performance and their plans for the future. So they will definitely make mention of the company's performance. And as part of our responsibilities as auditors, we are to ensure that whenever the directors make mention of our financial performance in their report, that it is consistent with our review. So for instance, we shouldn't have a case where our financial statement is saying that we made a profit of, say, 10 million, but then the directors in their report, because it's written, it's a different part of the other financial statement of that annual report, really different section. They now mention while writing that our profit for the year was 20 million. As auditors, if we find such inconsistency, we are required to point it out for correction where it is not corrected, we should express or state that in our audit report. So those are the provisions of CAMA as it relates, the law as it relates to audit. A second regulation which we want to consider, or a second law which we want to consider, relates to the responsibility of this body called Financial Reporting Council. So from the name, financial reporting, then council, that tells you that their job is linked to financial reporting. It's linked to financial reporting. So, what's the role of Financial Reporting Council? First, let's refer to what CAMA says about it. So the Companies and Allied Matters Act makes it mandatory for auditors to ensure that financial statements prepared in Nigeria comply with accounting standards issued. So these are accounting standards that are basically based on what we have from the Financial Reporting Council. So what's the responsibility of the Financial Reporting Council then? They're charged with the responsibility for, one, developing standards and rules that are to guide the preparation of financial statements, accounting standards and rules. Two, they are to publish those standards. It doesn't add any value if you develop something and then you put it in a drawer. So there's a link between development and publishing. And the third key responsibility is to enforce. Enforce would mean ensuring that people comply with these accounting standards in the preparation of financial statements in Nigeria. So as FRC really, they will look at some of the standards. For instance, we have what they call International Financial Reporting Standards, or IFRS. So the FRC will look at these standards and then make a determination as to which of them is applicable for companies in Nigeria to comply with. So, and then there are some too that they might feel that they need to make some modification to suit our own operating environment. So the Financial Reporting Council is charged with that responsibility. So what that basically means then is that if, for instance, we know IFRS, it's an international standard, if there's a conflict then between what IFRS says versus the guidance from the FRC, Financial Reporting Council. So which of these two should companies comply with? Companies will be required to comply with the provisions of Financial Reporting Council because they have the overall responsibility on standards, accounting standards in Nigeria. Please take note of that. The Financial Reporting Council has the overall authority on accounting standards that are to be adopted by companies in Nigeria. And so when there is a conflict between what they say and what IFRS says or what other international bodies says, their own rules, their own regulation is what companies are to abide with. Now, if a company fails to comply with the provisions of the provisions of the applicable rules, accounting standards as prescribed by FRC, there are penalties. So on conviction, they will be on conviction, such person would have a fine not exceeding 10 million naira or imprisonment for a term not exceeding 2 years or both, provided that the council shall bring such non-compliance to the preparers of such financial statement. So what that means is if there is non-compliance with accounting standards as prescribed by FRC, the punishment would be one, it should be disclosed. So that will be stated in the financial statement, either by the company, and if the company don't state it, the auditors would state that and ensure it is stated. So they will disclose it that we did not comply. That's the first penalty for it. Second penalty would be that the person or the entity that is involved could be subject to a fine, and it could be subject to imprisonment. So disclosure, fine, imprisonment. So those are the penalties for non-compliance with the prescribed accounting standards as issued by the Financial Reporting Council. So what are the functions of the Financial Reporting Council? We've discussed this. So the first thing is, for first responsibility is the develop standards. So look at the IFRS, if that's applicable, you pinpoint the ones that people should comply with. If you want people to comply with everything, you state that, mention what you want companies to comply with. If you think that there's a need to modify some of these standards to align with our operating environment, they do such modification. Second thing is that they publish the standard. So, because it doesn't make much sense if you develop something and put it in your drawer. So you need to let people know by publishing it. A third responsibility is to promote and enforce the general acceptance and adoption of such standards by preparers and users of financial statements. And then finally, you need to review from time to time the accounting standards developed in line with prevalent social, economic, and political environment. So the environment is always changing, things are always changing. And that's why most IFRS standards go through revision. So the same thing with standards that have been developed by Financial Reporting Council. It's important to look at them again and see if those standards are still relevant, if they're still applicable, or if there's a need for update. So for instance, years back, for standards that were developed on revenue, years back, there was nothing around Bitcoin, for instance. But then most companies now, individuals are beginning to have Bitcoin in their financial statements. So how do you report this? So once there are changes like that, it's important for the Financial Reporting Council to review and see where changes are actually required. So that's an example, really. So that's the requirements of the financial, as pertained by the Financial Reporting Council, their responsibilities and accounting standards. Then let's look at another law that is very important for auditors and for companies. And so that is what is called Banking and Other Financial Institution Act. So if you're a company and you operate as a bank, that means you need to comply with CAMA, which we just considered. You need to comply with the requirement of Financial Reporting Council, and also you need to comply with the requirement of this law called BOFIA. So this Banking and Other Financial Institution Act regulates the operations of banks and other financial institutions in Nigeria. Who is responsible for administering this act? It is the Central Bank of Nigeria. So it is charged with the responsibility of administering the provisions of CAMA, which aims at ensuring high standards of banking practice and sustaining financial stability. So these are the two key aims of CAMA. Please take note of these two aims of CAMA, really. One is to ensure high standards of banking practice, and two is to ensure that we have financial stability. Very important. So what are some of the provisions or requirements of CAMA? The first one is on the publication of annual accounts of banks and other financial institutions. So for this class of companies, it is required that the account is published not later than 4 months after the end of its financial year, subject to the approval in writing of the CBN. So what that means is that if, as a company, your financial year runs from January to December, so the BOFIA is saying that by April latest, which is 4 months after, your financial statement should be ready. Your financial report should be ready and they should approve it. So you need to send a report to them for approval. There are other requirements as well after it has been approved. So this is basically after it's been approved. You need to publish it in daily newspaper, printed and circulating in Nigeria. So basically, this means, take note of this part, printed newspaper. And so that is why if you take a look at the business section of most newspaper, published paper, you'd always see account of companies. And that's because we're trying to comply with the requirement of BOFIA that they publish their financial account in a printed newspaper. A second requirement is that you should have it displayed in each of your offices and branches. So you need to display it in your physical branches and offices. So if you want to confirm this, why not take a walk into one of the banks? Take a look around. You would always see their financial statement displayed in the banking hall. That is the requirement of BOFIA. So when next you go to the bank, be on the lookout for it. You'd see financial statement published, displayed in the banking hall somewhere around. A third requirement is a recent one. That's the provision that's included in CAMA 2020. So you might not find this you find it in CAMA 1990 and in books that were written before this was approved. So this requirement is that we should have a published financial statement on a company's official website. So when if you take a look at company's website, you can go search that or search any of them that's listed on the exchange, you would see their account financial statement published on their website. That is the requirement of CAMA. Fourth requirement is for the companies to forward to the central bank or CBN copies of the bank statement of financial position, statement of comprehensive income, statement of changes in equity that has been duly signed, containing the full and correct names of the directors of the bank. There's another provision of CAMA of BOFIA really as well, which you need to take note of, and that has to do with penalties. Penalties as a result of contravening the provisions of BOFIA. So if as a company, you do not comply with some of the requirements of this law, and then you had to be fined or had someone, a representative, go in prison, CAMA requires that you disclose it in your financial statement. And as auditors, we should ensure that such is done. Please take note of that. If you've breached any of the provisions of CAMA and you've had some penalties imposed on you, that should be disclosed in the financial statement for the year. And as auditors, it is our responsibility to ensure that such is reflected where the directors do not include it. Another provision of CAMA speaks to the content and forms of accounts, which every company, banks, and other financial institutions are required to maintain. And so every company is required to maintain a statement of financial position, which is called the balance sheet, statement of comprehensive income, which is sometimes called profit and loss or income statement, and statement of changes in equity. And this statement should comply with the requirements of any circular, any law that has been issued by the Central Bank of Nigeria and give a true and fair view of the state of affairs of the bank as at the end of the reporting period. So please take note of the requirement of that statement that needs to be included. And the CAMA 2020 actually also speaks to what we call a statement of cash flow. So you're going to have a number of statements that needs to be included in your annual report or your financial statement. So you have one, you should have your statement of financial position. Two, you should have your statement of comprehensive income. Three, you should have your statement of cash flow. And four, you should have a statement of changes in equity. And this statement should comply with all the laws we've been discussing, all the requirements, all the circulars by CBN, and give a true and fair view of the company's affairs as at when you are preparing that, that report. So what are the penalties for companies that do not comply with the provisions of CAMA? One, any bank which fails to comply with any of the requirements of this section in respect of each failure is guilty of an offense and liable on conviction to a fine of not less than 5 million and 100,000 for each day during which the offense continues. So what it basically means is that if a company does not comply with any requirement of CAMA, of BOFIA, sorry, any requirement of BOFIA. So for each of the offense or each provision that you are guilty of, for each provision that you are guilty of, you're subject to a fine of not less than 5 million, and then you have to correct that offense or that's a non-compliance. Now, for each day that you don't correct that non-compliance, you have to pay 100,000 for each day. So this is a provision of CAMA 2020. So if you look at CAMA 1990, the figures is much lesser than that, but this is the current provision that is in operation, really. A second penalty is any person being a director of any company who fails to take all reasonable steps to secure compliance with any of the prescribed provisions in respect of any of the account that the company is expected to keep is guilty of an offense and liable to pay a fine of 2 million or imprisonment for 5 years or both fine and imprisonment. So for a company, let's take that again. For a company, 5 million, 100,000 each day. For individual directors, 2 million and imprisonment. BOFIA, which is Banking and Other Financial Institution Act, also has in it some provisions as to the appointment, power, report of directors, really. So let's look at some of these provisions. One is the requirement that every bank shall appoint annually a person approved by the central bank, who is referred to as an approved auditor, whose duties shall be to make to the shareholders a report upon the annual statement of financial position, statement of comprehensive income of the bank, and every such report shall contain statements as to the matters and other information as been prescribed from time to time by the central bank. So basically, what we're saying is that every bank should have an auditor appointed, and that auditor appointment is to be approved by the central bank. So the question is, who approves the appointment of an auditor for banks? The answer, the central bank. And these auditors for banks and other financial institutions that have been approved by the CBN are referred to as approved auditor. Now, to be appointed as an approved auditor, you must meet some criteria, some requirement. So what are some of these requirements? One is that the auditor should be a member of one of the professional bodies recognized in Nigeria. Second requirement is that that appointment should be approved by the central bank. Third requirement is that the auditor should be resident in Nigeria. So you cannot appoint an audit firm that is resident outside of Nigeria. An audit firm that is not incorporated and resident in Nigeria, you cannot appoint them as your auditor. A third requirement is that this audit firm must be carrying on in Nigeria professional practice as accountant and auditor. Please take note of this requirement for approval of an auditor for banks and other financial institutions. It's an area that we have a number of questions in past papers. So, member of a professional body, approval by CBN, resident in Nigeria, carries on work as a professional accountant and auditor. Now, what if a company fails to appoint an approved auditor? What happens? The central bank shall appoint a suitable person for that purpose and shall fix the remuneration to be paid by the bank to such auditor. In our previous lectures on appointment and remuneration of auditor, remember we said remuneration is fixed by the person that appointed the auditor. So the person that appointed the auditor actually fixes the remuneration. So if an auditor, for instance, has been appointed, the first auditor really for a company would generally be appointed by the directors. So if they're appointed by the directors, their directors would fix the remuneration. And then for that, for 1 year up to the next annual general meeting. Now at the next annual general meeting, the shareholders would then appoint subsequently who the auditor of the company should be. And when they do, they also fix the remuneration. It's the same thing with auditors that are appointed by the central bank, where the bank or the other financial institution has not appointed an auditor. When the CBN does that appointment, they fix the remuneration. Please take note. When CBN appoints an auditor, they fix the remuneration of that auditor. Another law we want to look at, it's the Insurance Act 2003. So this would basically be applicable to companies that carry on insurance business. Please take note, this will be applicable to companies that carry on insurance business. So if you carry on insurance business, you would comply with the provision of CAMA/FRC and Financial Reporting Council, because this law is applicable to all companies. So regardless of the sector, the industry you operate in, you need to comply with the provisions of CAMA and FRC. Now, for Insurance Act 9, it's not an industry-specific requirement, regulatory requirement. So you now comply with your Insurance Act. So who administers the Insurance Act? This Insurance Act is administered by NICOM. Who administers BOFIA, which we just finished discussing? BOFIA is administered by CBN. Insurance Act is administered by NICOM, National Insurance Commission. So what are some of the provisions of NICOM that are applicable for exams? One is on the paid up capital that insurance companies are expected or required to maintain. So the paid up capital basically depends on the type of insurance business. The type of insurance business you undertake determines the capital you are expected to have. So if your insurance, you do what you call life insurance business, you provide insurance regarding life assurance, your paid up capital is 2 billion. If you're engaged in general insurance business, so the word here is general. That's the key word there. So you're basically insuring cars, insuring property, insuring every other thing. Your paid up is 3 billion. And this general excludes life. So every other thing, excluding life, your paid up capital is 3 billion. Now, if you engage in what is called a composite insurance business, the paid up capital is 5 billion. Did you notice anything? Yeah, you'd see that 5 billion is 2 plus 3. So that basically tells you that a composite insurance business is an insurance company that is engaged in life and general insurance. So insurance companies could decide to say, okay, as an insurance company, we want to do just life, we want to just provide cover for life, or we want to provide cover for every other thing except life, or we want to provide cover for both life and general insurance business. Another class of insurance which companies could engage in, and the paid up capital is 10 billion, is reinsurance. So what does it mean? What is the meaning of reinsurance? So you look at it, it's a combination of two words. You have a re, then you have insurance. So what that basically means is that when as an insurance company, you are engaged in insuring what someone has insured. So this is you have to keep it at the simple form. You have a car for 10 million, what 10 million which you insure, and insure it with a company called ABC. Now this company called ABC is concerned that this risk, when it crystallizes the an issue, it decides to also insure what it has taken on with another company called BCD. So this BCD is into a reinsurance business because it is taking on a risk that someone else has taken on. Sorry. So that's the paid up capital for insurance business. There are certain requirements by Insurance Act regards to the records of insurance companies. So what are the requirements? One is where an insurance company carries on the two main class of insurance business, and that is life and general insurance, separate and distinct account should be kept for it. So you cannot combine your account for life insurance with your account for general insurance. That's what the law says. So you should have your account for insurance should be different. Your account for your account for life insurance should be different from your account for general insurance business. You cannot combine both and say, oh, ABC insurance, this is our account for the year. If you are doing two different classes of business, give us the figures for the different lines of business. Insurance Act 2020 also requires companies to maintain provisions and reserve. So provisions could be provisions for unexpired risk, provisions for outstanding claims, contingency reserve, and contingency reserve fund. So what do we mean by unexpired risk? Let's quickly discuss some of these terms really. Unexpired risk. So as an individual, let's say you have a house and you take on an insurance for January to December, and you pay the insurance company and you say, okay, I'm taking on a fire insurance to protect my house against insurance for the period January to December. Now, before December ends, between January and December, this risk has not expired. After December, the insurance company is no longer liable to you except you decide to renew that insurance. So the period within which the insurance company would have to pay you if the risk crystallizes. So there's a need to make that provision called provision for unexpired risk. There's also a provision for outstanding claims, which is basically what people are making claim on, reimbursement for risks that has crystallized. So you need to make a provision for that as well. So let's look at some of the returns to NICOM. So what does NICOM expect insurance company? What account do they expect insurance company to provide to them and to the public? One is the statement of financial position at the end of the financial year, plus the relevant profit and loss account meant for presentation to the shareholders at its annual general meeting. That's the first document of financial record that insurance companies are required to maintain. Second return is a revenue account applicable to each class of insurance business for which the insurance company is registered. So we discussed about this. If you carry on two class of insurance business, which is called composite business, you need to have your account for each of this line of business maintained separately. A third return is a statement of investment representing the insurance fund. The other requirement as well, so in each year after receipt of the approved financial statement by the commission, insurance companies are required to publish these statements in at least one newspaper having wide circulation in Nigeria. So this is the same provision we have it in BOFIA as well. You're required to publish your financial statement in a newspaper, at least one newspaper. So that's the key requirement of BOFIA. So those are the provisions of the law as regards in accounting standards and audit. So as auditors, we should pay attention to what laws guide the companies we're going to audit. If it's a bank, that or any company that provides financial services, they need to comply with the provisions of BOFIA. An insurance company, they need to comply with the provisions of the Insurance Act. Every other company, including the ones we've just mentioned, need to comply with the provisions of CAMA and FRC. Financial Reporting Council is the overriding body for accounting standards in Nigeria. So they determine what accounting standards companies should adopt in preparing their financial statement. The next section we're going to consider is professional ethics. Ethics. That's a word that is regularly used. So what is ethics? So ethics refers to a system or code of conduct based on moral duties, values, and obligations that indicate how we should behave within a constituted body or society. So keyword here is a code of conduct. So ethics gives you this code, these principles, these values that show, that tell you how you should behave within a constituted body or society. That means that most ethical codes, most ethical standards, most code of conduct will be binding on a particular body or society. And so that is why we have the ICAN ethical code, because as a body, we require that those rules, those code of conduct, those principles that will guide the behavior of our members. So the same thing for society. So if you join, people that join different associations, different bodies, they always tell you, this is our code of conduct. This is our guiding principles. So these are all ethical code. So simply put, ethics refers to a set of principles of right conduct for members of an organization or group. So what does ethics help you do? So if you need to make a decision, for instance, on what is right, is this thing right, is this thing wrong, you refer to what? The ethical code. Is this good? Is it bad? Is it evil? So you refer to the ethical code and the principles to guide your behavior. So ethics then provides that code of conduct for members. So for auditors, we belong to a professional body. We're all members of our own professional body as accountants, which is the Institute of Chartered Accountants of Nigeria. And being a member of this body, or being a member of the Institute of Chartered Accountants of Ghana, whatever your professional body is, there's a need to comply with the rules, the codes for that body. So auditors are expected to comply then with the rules of professional conduct for members issued by their professional accounting bodies and accounting standards issued by the Financial Reporting Council of Nigeria. So take note of this. The code you need to comply with is that is issued by your accounting body, in which case, let's say ICAN, and a code that is issued by the Financial Reporting Council. For our own professional body, really, which is ICAN or Institute of Chartered Accountants of Ghana, and most professional bodies, really, the guidelines to guide our professional duties is detailed in our ethical code, and it is a mandatory requirement for membership. So why do we have this code? Please take note, why do we have a code of conduct? Basically, it is to provide guidance to members in the discharge of their professional duties. So that's the key reason why we have an ethical code, to provide guidance. And that's because you can't document every single thing in laws and say, don't do this, don't do that, don't do this, don't be explicit. You wouldn't be able to cover everything. Certain things are going to come up that might not be covered by the law, specific law you've written. But if you have a code, principles, one can always refer to those principles to guide behaviors and decisions. So what are some of the ethical principles, ICAN ethical principles that are important for us as auditors? There are about 12. One is fundamental principles. Second is the need for integrity, objectivity, and independence. Third, it's conflict of interest. Fourth, it's confidentiality. Fifth, speaks to changes in professional appointment. Sixth, consultancy. 7, guidance for associating with non-members, fees, obtaining professional work, use of letterheads, members in business, enforcement of ethical standard. So why do we have these? Why do we have these issues? The key thing is, the key word there is to provide guidance to members of the professional body in the discharge of their professional duties. So if you need to make a decision, you should refer to the code, especially for decisions that are not explicitly stated. Refer to the code and let your decisions be guided by the principles contained in the code. So let's start with the fundamental principle. So for members of our professional body, professional accounting body, when we say fundamental, we're looking at the key, the central, the primary principles, the primary code of conduct that govern our activity. So the first code is integrity. So as a member of a professional accounting body, you should maintain a high level of integrity. Integrity means that you should be honest, you should be straightforward, you should be open, you should be fair. That is the meaning of integrity. So if you're going to undertake or make a decision, if it's something that it's not doesn't lead to being fair to the parties involved, or it involves having to hide certain things, or having to not be straightforward in your actions, you know that you've breached that principle, because auditors are expected to maintain a high level of integrity. A second fundamental principle is objectivity. A member should strive for objectivity in all professional and business judgment. Subjectivity is the state of mind which has regards to all considerations relevant to the task in hand, but no other. So objectivity means that your decisions should be based on facts. It should be based on fact. It should not be based on emotions. That is why it says it links it to a state of mind. It should not be based on emotion. It should not be based on what you want, but based on what it actually is, based on available facts. A third fundamental principle for accountants and auditors is that an auditor should be competent in whatever engagement he or she is to undertake. And so what that means is that a member should not accept or perform any work which he or she is not competent to undertake unless he or she obtains such advice and assistance as will enable him or her to completely carry them out. So if you don't know the job, or that particular review is not within your area of competence, you have to decline that engagement, that job offer. That is in line with that fundamental principle of competence. Now, you can only accept that engagement if you are sure that you can have that relevant competence in place. And how can you have in place that competence? One is to employ the services of an expert. So for instance, you have another engagement to do a review or an investigation and involve systems, IT systems, sophisticated IT systems. And in your audit team, you don't have someone that has that knowledge. So what you can quickly do for you to accept that engagement, if you think you want to proceed with that engagement, to meet this requirement of that engagement, is to employ an expert, employ someone who is knowledgeable in that area. A second thing you could do is to obtain the necessary training to carry on that audit. So you could get necessary training, necessary support to conduct that audit. However, where you feel that, or where you cannot get experts, and you also cannot get the required training to complete that job, or the training on ground will not be sufficient, give you the required skills and competence to complete that job, the auditor should not accept such an engagement. That's the third fundamental principles for auditors and professional accountant. A fourth fundamental principles is the requirement for auditors to carry out their work with due skills, care, and diligence. So to have a knowledge is one thing. To be able to conduct it diligently is another thing. It's required that auditors should conduct their work diligently with regards to proper technical and professional standards expected of him or her as an auditor. So you should be able to carefully conduct your work. A fifth principle is that an auditor should conduct himself or herself with courtesy and consideration toward all those with whom he comes into contact during the course of performing his or her work. So auditors should not abuse their privilege or abuse the job they've been given by, for instance, trying to impose certain actions or decisions on the owners of the business. No. Conduct your work with high level of courtesy and consideration. in line with the applicable requirement of the law. Another requirement, which is the sixth fundamental principle, is that of confidentiality. So a member should respect the confidentiality of information that they acquire as they carry out their professional duty. So they're not required, they're not expected to disclose that information to third party or use that information for their own personal gain. So for instance, the company, you're going to review a company and you discover that the company is planning, or a bank is planning to acquire another bank next year, or in 2 months' time, or in 3 months' time. And then you quickly, based on that information, go and buy shares in that bank. And then expecting that as soon as the announcement is made that, oh, we've acquired this other bank, the share price will rise, and then you'd have made profit from it, and you sell, and then you cash out. That is a breach of fundamental principles of confidentiality. Let's look at the next ethical code, really, which speaks to independence. So independence requires both independence of mind and appearance. So for one to be independent as an auditor, there are two things there, two key elements: independence of mind and independence in appearance. So independence of mind would mean that you should not have a biased mind towards an audit engagement. Free from bias. That's what it basically means. So for instance, if you have a significant shareholding in a company, you know that for you to receive dividend, the company needs to make money. So what you ordinarily prefer, what you want, is for the company to make money. So that causes you to question your independence, because you'll be more, when you go to conduct that audit, it's easier for you to let go of things that result in the company making more money or increasing its profit, so that you can also get as much dividend as possible. So that refers to independence of mind. You should be free from any form of bias. But then there's also what they call independence of appearance, in appearance. So in appearance would mean what people see, what people think it is. So let's say, for instance, as an audit partner, an audit engagement partner, you're related, the CEO is your uncle. CEO is the uncle to audit engagement partner. Now, but between the two of you, there's really no relation, there's really no connection. You really don't communicate with your uncle. You really don't have any form of close relationship. So you are there to do your job as if he was just a third party, every other person. So for you, you have this feeling that I don't have any question as to my objectivity, my independence. But for someone outside, there is this appearance, there's this feeling that no, but they are related. So he will not be objective in carrying out his work. So that is what it means by independence, free from independence with regards to appearance, independence in appearance. So even though you might be independent behind the scene, but in appearance, to people out there, there's a question as to your independence. So in order to exercise his independence, there are a number of things that an auditor must not do. So what are some of the things that an auditor must not do in order to maintain his independence? One, must not possess any direct or indirect beneficial interest in any company for which he or she is to act as auditor. So beneficial interest. So for instance, you have a shareholding in that company. That's one we just mentioned. Two, if you're undergoing an interview to move to the company you're auditing, there's an interest, you have an interest in that company. So that might actually impact on your objectivity and independence. So you shouldn't have any form of interest in the company. Second thing an auditor in practice should not do, it should not accept fees, the amount of which is based on the success of an assignment except where these cannot be avoided because of legislation or agreement to which he is not a party to. So what it basically means is your fees should not be based on the success of the assignment. So what I mean by success is, for instance, should not be based on the number of exceptions. So you cannot say that as an auditor, we're going to pay you 100,000 if there's no exception, and if there is an immaterial exception, we'll pay you 50,000, and if there is a high immaterial exception, we'll pay you 10,000. No, your fees should not be based on the success of an assignment or the result of that audit review. A third thing to take note of, which is linked to the second one, is you should never accept fees, the amount of which is based on the turnover of the company for which you are acting as auditor. So basically, it shows that your fees should not be linked to revenue or profit, should not be linked to profit or revenue. So you cannot agree a fee where you say, my audit fee is 10% of revenue. This is wrong. You cannot accept a fee where we say, my audit fee is 10%, 15% of profit. That is wrong. So your fee should not be tied to the performance of the company you are auditing. That's the second one. First, should not be tied to the performance of the company, financial performance of the company. It should not be tied to the assignment, the success of that assignment, the number of exceptions in that assignment, the report, how lovely the report is. Your fee should not be tied to that. You should not accept any engagement that is actually tied to that, or where the company is proposing to tie your fees to that. A fourth thing to take note is an auditor should not accept any engagement to act for two opposing parties in respect of a negotiation, claim, or settlement unless appointed as an arbitrator under due process of law. So basically, you should not act as auditor for two opposing parties. So that's the key word. So let's say, for instance, you have a company that wants to sell its company, wants to sell its business. So you act as an auditor for that company. Okay, so we want to sell our business. You are our auditor. You're doing our own review. Then there's a company that wants to buy the business. So you can see that buy is the opposite of sell. So as an auditor, you cannot act as an auditor for the person that is selling and for the person that is buying. So that presents a conflict of interest, really, and it impacts on your independence. That's because the person that is selling, we want to find out, so get some information about the person that is buying, and the person that is buying, we want to find out some information about the selling party. So there's that conflict, and the person that is selling wants to get as much money as possible. The person that is buying wants to buy it for as low as possible. So as an auditor, we shouldn't act for two opposing parties, except it's required by law, or you're really not. You are appointed as an arbitrator or someone to resolve a disagreement, really. A fourth thing to note is that an auditor should not carry out work concurrently, should not carry out the work as an auditor concurrently with carrying out work for the client in executive capacity. So as an auditor, you cannot be member of a management team with company you're auditing. Very, very important. The auditor should not give or take loan from clients. Similarly, anyone closely connected with him or her should not make loans to his or her client receive loans from the client. The same applies to guarantees. Overdue fees may in some circumstances constitute a loan. This is important because if you get loan from your client, person you're auditing, you get loan from them. That creates a conflict. You have an interest there. So you want to protect that interest by ensuring that you do not take loan from your client. If you give loan to your client, you want your client to be in business so that they can pay you back. So you wouldn't want to a financial report that would show that they are sinking. So that will empower your independence. So as a result of this, the law requires that as an audit firm, you should not give or take loan from your client. And as much as possible too, try to avoid cases of overdue fees, as this may in some circumstances constitute a loan. So the audit company you're auditing is owing you for like 2, 3, 4, 5 years. Consider the loan. It begins to empower your independence because you want to collect your money back. So because you want to collect your money back from that company, there is that interest in the affairs of the company. You're interested in how the company performs. You're interested in what is happening in the company because you want to get your money back. Another requirement for auditors and professional accountants is that we should not accept goods or services from a client or by anyone closely connected with him or her unless the value of that benefit is modest. Acceptance of undue hospitality poses a similar threat as well. So auditors are required not to accept gifts, not to accept services, free services, subsidized services from your audit client. What if your audit client it sells some items or offers some services and you actually require that service? Does that mean you shouldn't procure that service from your audit client? No. You can actually procure a service from your audit client. You can actually buy from your audit client, but you should not accept a fee or a price. You should be charged a fee or a price that is lower than what they would ordinarily charge if you are not an auditor. So let's say, for instance, you're auditing an audit firm that sells machineries. Let's put it simple. Let's say they sell cars, and they will ordinarily sell a car for say 10 million. And as an auditor, you require a car, and then you need to want to buy a car, and then you come to this audit client to produce a car, and they say, well, because you're our auditor, we'll sell this car to you for 5 million. The auditor should do what? Should decline it. However, what if you come to the firm and the price of the car is 10 million, and they say, okay, this is the price of a car, it is 10 million, and you pay your 10 million for the car? That does not impact on your independence, because that is the price you ordinarily pay for it, even if you are not an auditor. So auditors should not accept gift or service from any client or any form of discount that is tied to the fact that they are auditors. However, there is an exception, and this is where the item is value. The value of that benefit is modest. So let's say, for instance, you're doing an audit and you provided with biros, calendars, and these are modest. These are not items that impact on anybody or the auditor's judgment. So those can be accepted. But for high value item, benefits of high value, the auditor is expected to decline such gift. Auditors should not establish family or personal relationship with client companies. So for personal relationship, that is within your control. You decide who you want to maintain a closeness with. But for family relationship, you can't decide who your family member is or who your family member should be. So what then is expected if it's an auditor to find out that the top member of that company is related to you? Now, if it's just you as a person, then you should not be part of that engagement. Someone else should undertake that job. But if the relationship is in terms of it's a related company, then as an audit firm, such an engagement should not be undertaken. To maintain your independence, auditors should not allow the existence of actual or threatened litigation. That's legal action, really. Litigation or threatened litigation between the client company and an audit firm will mean parties being placed in an adversarial situation which clearly undermines the auditor's objectivity. And so if there's a court case between you and the person you're auditing, one, there will be a breach of trust. There'll be a breach of trust. So when there's that breach of trust, the company you're auditing might be reluctant to provide you with information. And even the auditors at their own end, they might not be objective. They might want to pay back the company in its own coin, so to say, really. So as auditors, we should avoid actual or threatened litigation with a client we intend to audit or an audit client. Another professional code of conduct for professional accountants, ICAN member, is called objectivity. So we discussed the fundamental principles, we discussed independence, and we're speaking about objectivity. Objectivity is essential for any professional person exercising professional judgment, not just auditors. So if your job involves making judgment, making decisions, then you need to be objective. This principle applies to basically all professions really that exercise professional judgment. So what is objectivity? Objectivity refers to the quality or character of being objective. In other words, lack of favoritism towards one side or another, freedom from bias. There are a number of terms we need to note the difference between them. One is objectivity, subjectivity, and independence. So what's the difference between these terms? So let's start with objectivity. So objectivity, like we mentioned, is state of mind. Having what? An independent mind. That is objectivity. The state of your mind. Is it free from bias? That is objectivity. Subjectivity refers to a situation whereby you're making your decision based on your personal perspective or preference. So based on so for instance, you're conducting an audit, and because you have a good relationship or a personal family relationship with the person you're auditing, you ordinarily don't want there to be any issue from that audit. You want the audit to be clean. You don't want there to be any exception. So that's your preference. Once you start having that personal preference, what you prefer to be the result of that audit, without even conducting any review whatsoever, you already have a mindset. You are set to be what? To be subjective. Independence, on the other hand, speaks to structure or things that can impart on your objectivity. That is what independence. It speaks to structure or activities that can impart on your objectivity. So for instance, if you have an audit client where they are owing you the audit fees for like 5 years, that is a threat to your independence. But the fact that they are owing you does not necessarily mean that you'll be biased towards them. Yes. But once that bias comes in, then the concept of objectivity comes in. So you might have a threat to your independence, but then behind the scene, you're objective because your state of your mind is different from the structure or the situation that could impact on your objectivity. So independence speaks to the structure, the activities that can impact on your objectivity. So that's why there's a link between both when discussing both of them. So it's structured activities that can impact on your objectivity. Your objectivity speaks to your state of mind, freedom from bias, lack of favoritism. Objectivity is the opposite of subjectivity. We've mentioned that really, because we said subjectivity refers to, is based on your personal preference or of a particular person. So once you have that personal preference or something, you could be said to be subjective. So to be considered objective, what is expected of the auditor? So that we can say that, oh, this auditor is objective in conducting this audit engagement. So to be considered objective, the auditor is required to review or take into consideration all the available information, all information available based on the books of accounts submitted to him, and express his decision or base his decisions only on the data and the guiding principles of the profession. So basically, to be considered objective, we're saying that your decision, whatever decision you express as to the true and fairness of financial statements, should be based on data, should be supported by data. So once your decision, your statement, your opinion is not based on verifiable data, reliable data, then it can be said that you are not objective. Second requirement is that it should be based on the guiding principles of the profession. So, when can an auditor's opinion be considered to be an objective one? Two key criteria must be met. One is that that opinion should be based on available data. Two is that that decision, that opinion should be supported based on the guiding principles of the profession, which we are currently discussing: the fundamental principles, independence, objectivity, and the rest as we go on. Let's look at another ethical conduct expected of auditors, and that is what? Confidentiality. That is what? Confidentiality. So what is expected of auditors? An auditor shall comply with the principle of confidentiality, which requires that auditors and accountants should respect the confidentiality of information acquired as a result of professional and business relationship. So as you go on with your job as auditors, you're going to be exposed to a lot of information from the audit client. You need to respect the confidentiality of that information. An auditor who acquires information in the course of his work should neither use nor appear to use that information for his personal advantage or for the advantage of a third party. So what that means is that the auditor can't say, but I didn't use the information for myself. I told it to my friend. It was my family member, because my friends that made use of this information to their advantage. That is wrong. So the auditor should not disclose information that would actually lead to that actually taking place, really. However, there are exceptions to this rule on confidentiality, which auditors should take note. Please take note of this exception to confidentiality. Situations under which an auditor may disclose a client information to outsiders. If it doesn't fall, if these criteria are not met, the auditor should never disclose a client information to external parties. One, is where you've obtained the approval or consent of the client to disclose that information. In that situation, you can go ahead and disclose. 2 is required by law. When in the course of your audit, you know or suspect, to take note of it, you know or suspect that your client has committed an offense of treason, terrorism, drugs, or money laundering. In this situation, the auditor is required to disclose this information to a competent authority. Competent authority, not to the public. Not that you found out that the company is involved in money laundering, and then you call your friends and start letting them know that professional ethics said I should disclose what I was. No, it should be to a competent authority. Competent authority as provided for in the law. So some laws require that the auditor should disclose this discovery to the company to Economic and Financial Reporting Commission, for instance. In some jurisdiction require that you should report it to the registrar or commissioner for companies or something like that. So there are spelled authorities that are responsible for receiving this report, and those are the parties the auditors should report to, not to just anybody out there. A third situation where an auditor can breach the confidentiality rule is where there is material non-compliance with laws and regulations. So as an auditor, don't forget our role is to express our opinion as to the truth and fairness of the financial statement. And we are concerned about material amount. And so when in the course of your audit, you discover that the auditor did not comply with a particular law, and that law has led to significant uncertainties or meant that you disagree with the way certain things are treated, you are required to make that disclosure. So there are 2 things that can really resolve when an organization does not comply with laws, really. 2 is what is called significant uncertainties. So that would mean, for instance, there is a breach, and the penalty for that breach would be that the company's license will be withdrawn. However, that matter has not been taken to court, it's not been judged, there's not been any court order yet really on that, but that risk exists. So that is a significant uncertainty. Another could be that non-compliance would mean that the way you report, the value you report in your account would be significantly different if you are reported it based on what the rule or the law says. A fourth exception to the confidentiality rule is where an offense has been committed which is contrary to the public interest. So in such situation, the auditor has an obligation to make disclosure. So for instance, you're performing an audit. I always like to make reference to a pharmaceutical company. You're auditing a pharmaceutical company, and in the course of your audit, you discover that the drugs that they're selling and manufacturing is dangerous. So what that means is that the drugs out there, as the public consume it, is having a damaging effect on their health. As an auditor, in the public best interest, you have an obligation to disclose. The fifth exception to the confidentiality rule is where disclosure is compelled by law, where it is specifically required by law that you are meant to disclose this or you're meant to disclose that. For instance, if there is a court case and the auditor is asked to come and give testimony in court, in such situation, it is required by law. Auditor is required to make necessary disclosure as required by law. So please take note of this exception to the confidentiality rule. Outside this, auditors are required to maintain high level of what? Confidentiality. Now, in addition to the exception it is important for the auditors to have to consider some other things in deciding whether to make disclosure. This part excludes mandatory disclosure. That's what we said for non-mandatory disclosures. For mandatory disclosure, those are the ones that are required by law. So you have no choice but to disclose. But for other matters, it's important to consider other things as well. One is it's important for the auditor to consider whether the interests of all parties, including third parties, may be affected or they could be harmed if the client or employer consents to disclosure of information by members in public practice. So you want to consider the impact of that disclosure on third parties and on other parties as well. Two, you also want to consider whether all the relevant information is known and substantiated, and to the extent that is practicable, really. When the situation involves unsubstantiated facts, incomplete information, or unsubstantiated conclusion, professional judgment should be used in determining the type of disclosure to be made, if any. So we do not want to be peddlers of rumors as auditors, so to say, really. So we need to ensure that our information is substantiated, is based on fact. However, because it is not our responsibility to investigate or to carry out detailed investigation, so that means that sometimes you might have high level of suspicion based on preliminary review. In such situation, auditors should make use of what? Professional judgment. So what is professional judgment? Professional judgment is you should apply your experience based on what you've done and based on advice, legal advice. So as a professional, we're all professionals, we've gone through training. So use that, the knowledge you have, to make what? A decision on the type of disclosure to be made. A third consideration auditor need to consider, to look at, is the type of communication that is expected and to whom it is addressed in particular. So members should be satisfied that the parties to whom communication is addressed are the appropriate recipient of that communication. So the key term here is appropriate recipient. And so that's what we mentioned much earlier, that if an auditor in the conduct of his duty, for instance, discover that a company is into money laundering, and the law requires that cases like this should be disclosed. But the appropriate authority in this case might be, for instance, if the bank, it might be need to disclose to the central bank. It might be the need to disclose to the Financial Crimes Commission, Economic and Financial Crimes Commission. So these are the appropriate authority. So that basically means that the auditor cannot now start disclosing that information to his friends or family members. That is because this group of persons are not appropriate recipient of that information. So we looked at professional ethics, really expected of auditors. So pay close attention to the requirement. The fundamental principle speaks to much of what we have in the other section, really. So let's take note of this principle that guide the conduct of auditors. And let's also remember that in our earlier class, we mentioned that the auditor is not liable for all forms of fraud. We also mentioned that the auditor is not responsible for fraud prevention. We also mentioned that the auditor is not responsible for providing absolute assurance. So these are all terms that we've discussed in our previous session. However, it's important to note that as auditors, we can be liable for our actions. We can be charged to court. We can be convicted for some of our actions. Our license, practice license as professional auditors can be withdrawn. So what are situations where the auditor could be held liable. First, it's important to first look at what our responsibility is once more, really. So as auditors, what is our responsibility? The auditor has responsibility to shareholders and to other third parties who may place a level of reliance on the financial statement certified by him. So as auditors, don't forget our responsibility to express what? To express opinion as to the truth and fairness of the financial statement that is laid before us. People rely on that financial statement. The shareholders rely on that statement. So some people that have shares in the company make a decision as to whether, okay, we want to sell our shareholding, or we want to make further investment, or we're meant to make certain decisions on the company we have. So they rely on that financial statement for their decision. Other third parties, for instance, banks. As a company, if you go to collect loan from a bank, they would always ask for your financial statement, your audited financial statement. So based on that audited financial statement, they're able to make a decision as to whether that loan should be provided to you. So as a result, it's expected that the auditor should maintain level of care and due diligence in conducting that review. If the auditor fails to meet the standard of care required, and consequently a loss is suffered by any of the affected parties, remedy can be obtained against the auditors in a constituted court. Two key elements must exist for an auditor to be liable. To take note of that, two key elements must exist. One is the auditor fails to meet the required standard of care. So this is the first thing. A second thing is that a loss is suffered as a result of this. So if, for instance, a loss is suffered by a member of the company, but that is not because the auditor did not do what it's meant to do, then in that situation, auditor's liability does not come in. Please take note of that. These two elements must exist for an auditor to be held liable. One, the auditor must fail to meet the standard of care that is expected of them. And two, other party would suffer a loss as a result of that false statement that is provided by the auditor. The auditor is therefore expected to be honest. That is, he must not certify what he does not believe to be true, and he must take reasonable care and skill before he believes that what he certifies is true. Because if it says financial statement is true and fair, and somebody relies on that financial statement, shareholders and some third party, and they suffer a loss, it is what? Liable. Now, what the auditor is expected to do is to take what is called reasonable care. Reasonable care. It's important to note that reasonable care depends on the circumstance and can sometimes be very difficult to access. Depends on the circumstance and can sometimes be very difficult to access. However, reasonable care generally implies four things. Take note of this. One, for an auditor to be said to have exercised reasonable care in exercise of the audit engagement, one is that he must possess the skills to conduct the audit. That is a fundamental principle. If you recall, we discussed that he must possess what? The skills to do what? Conduct it. 2, he must employ such skills with due care and diligence. Carefully employ that skills in the conduct of what is duty. So what that means is, for instance, if an auditor in the conduct of the audit is found out that, okay, a company made an acquisition of a new vehicle, and they say that that vehicle is 50 million, which and is a material amount. Now, due care will require that you've seen this 50 million recorded in the account as purchase of vehicle. And then you ask, the client said, you purchased a 50 million naira vehicle, and then you don't conduct any other check. You tick it as correct. Yes, they purchased 50 million naira worth of vehicle. That won't be considered to be due care, because as auditors, you expect to do what? To verify. To do what? To verify. So the next step for you would be to do what? To ask the auditor and say, okay, can I see this vehicle? Can I see the document, the purchase document for this vehicle? To even be sure that it is in the company's name. Can I see the physical vehicle to be sure that it exists? So that is what? Taking due care and diligence in carrying out the review. A third thing that implies reasonable care is that the auditor should undertake his task with good faith and integrity. So should be honest, should be straightforward in the work. But then that doesn't mean that the auditor is perfect. It doesn't mean that the auditor is infallible. No, but the auditor should generally undertake what someone in that same situation would already do in conducting that review. Fourth, note that the auditor may be liable for negligence, bad faith, or dishonesty, but not for mere errors in judgment. Key point, not for errors in judgment. So judgment by the auditor won't be held liable for it really. But for negligence, not doing what you are meant to do, you are liable as an auditor. So what are the key auditors' responsibility? It's important to note in carrying out your audit that it is possible that as an auditor, as an audit firm, that you fail to exercise skills and care in the conduct of your audit. So you should take note that this is possible so that you can guard against it. So where the auditor fails to exercise this sufficient skills and care, as a consequence, fraud or error may not be uncovered, or the auditor may fail to discover that the accounts fail to show a true and fair view, or that the account contains a material misstatement. The auditor fails to exercise due care, fails to exercise sufficient skills in that work. As a result, fails to detect that the account has issues, it has errors, it has amount that cannot be substantiated. And then it says, but this financial statement that we've reviewed is true and fair. And then it is published. As a consequence of that, someone who relies on that work, on that statement, may lose money. So if, for instance, the bankers rely on that statement to grant loan to the company, and then down the line, they realize that this company does not have what it takes to repay, and that the cash, the asset they present in their books, which the auditor certified to be true and fair, doesn't even exist. So in that situation, it's very possible that the bankers that lend that money would lose the money that lent out based on the fact that they had relied on that financial statement that was certified by the auditor. And this loss of money would generally flow from the failure of the auditor to do his job properly. This means that auditors may indeed be liable for professional negligence. So liability by the auditor can be for professional negligence. Auditors can also be liable under certain laws and can also face penalty under some criminal law for deception and reckless negligence. So negligence can be twofold. One is the fact that you didn't do what you're meant to do. You're just negligent. You didn't check what you're meant to check. You didn't do a proper review. You didn't look at. You didn't do a proper materiality review to check that transactions that are material. That's one. A second one could be because you want to be deceptive. You are part of the fraud. So, for instance, as an auditor, you have a significant shareholding in that company. As an audit firm, for instance, you have a significant shareholding in that company. And you know very well that if you issue a statement that is true and fair, it will show that that company made significant loss. And so, despite you knowing that this statement is false, you actually deliberately go along with management and the directors to issue what? A deceptive report. In such case, in such situation, you are liable under what? Criminal law. Because what you have done is you've committed a crime. So an auditor can be liable under criminal law when they commit what? A crime. When the parties to fraud, really. It is also not uncommon for auditors to be liable under civil law for damages. Furthermore, an auditor will be held liable under the law of tort for duty of care, especially where a third party is involved. So duty of tort speaks to the auditor's liability to third parties. So there are 3 or 4 key areas where an auditor can be liable, which would consider next, but let's quickly highlight it. One is that an auditor could be liable for negligence, which is linked to civil law. 2 is that an auditor can be liable under what? Criminal law. For what? For crime. Now, this liability will generally be to who? To shareholders or the owners, because they are the ones that employ the auditor to conduct a review. They are the ones that brought in the auditor to conduct a review and to give them, express an opinion to them as to the truth and fairness of the financial statements prepared by management. However, there could be other third parties that rely on the financial statements, such as banks. So in that case, the auditor can be liable under what is called law of torts. So the law of tort speaks to the auditor's liability to third parties. That is what? Law of tort. Auditor's liability under law of tort. The auditor's liability to third parties. So, but before we speak to each of these liability, let's look at how an auditor can limit its liability. One, it's pretty obvious. Do the right thing. Perform audit work with due care and diligence. So as an auditor, if you don't want to be charged to court for performing a negligent job, for performing a shady job, ensure that you perform your work with due care and diligence. If you don't have the skills, you don't have the knowledge to undertake that assignment, do not accept the engagement. If you must accept the engagement, seek out the services of an expert or get your audit team well trained on that job. That is one way an auditor can limit auditors' liability. A second way is through what? Insurance. Now, in this case, it's not as if the auditor will not be sued or something, but the auditor has an insurance such that if he's taken to court and they say, come and pay 10 million, the auditor can turn to his insurance company and say, I took an insurance against lawsuits, against my liability. But yeah, I need a refund for this charges. However, take note that when an auditor takes an indemnity insurance, it does not safeguard it against withdrawal of license. Very, very important point. Does not protect against withdrawal of license. That's an important point because insurance is more like a compensation for you. That's what insurance is all about. You suffer loss, go to your insurance company, and you get a premium. You get a premium for that. Being you are reimbursed for that, really. A third way auditors can limit their liability is to enter into a limited liability agreement with the company they are auditing. So basically, what this means is in your letter of engagement. Remember, letter of engagement as a contract document that details the responsibilities of the parties to that audit, management responsibility, auditor's responsibility. So in your letter of engagement, you will include in there that any lawsuit, any claim against the auditor should not exceed a particular amount. So you are able to cap the amount of liability you are exposed to in conducting the audit. However, it's important to state that some laws prevent auditors from having a limited liability agreement, especially when you're auditing a company that is quoted on the stock exchange. That is a public company. But for other companies, you can actually have a limited liability agreement with them if they actually agree, if the company actually agrees to it. So let's now look at auditors' liability for negligence under the various laws. So we look at three main categorization: under common law, under law of contracts, and then under criminal law. So first thing is auditors' liability under common law. Now, in reviewing auditors' liability under common law, we need to consider two things: what common law is, when does liability exist, and what do we mean by negligence. If you look at that subject, you have negligence, common law, liability. So these are the terms that you need to understand for your exams. So what is common law? Common law, this is a law that is derived from customs and judicial precedent rather than statutes. So based on the past, this is how what is expected. So take, for instance, you take your car to a mechanic to work on. Based on what is obtainable, based on what we know, it's expected that the mechanic should do a good job on your car. It's expected that the mechanic should not bring out the car in the worse state than it was when you took it to him. So based on this precedent, customs, what has been existing, the auditor is liable for negligence under that law called what? Common law. However, for an auditor to be found liable, two things must have happened. One is that it must have been confirmed that the auditor was negligent in his work. Two, that the client suffered the loss as a result of that negligence. So if the auditor was negligent, but the client did not suffer any loss as a result of that, then under common law, the auditor would not be liable. If the client suffered a loss, but the loss is not as a result of the auditor's actions or statement on the financial statement, as a result of the auditor's report on the financial statement, then the auditor is not liable. So these two criteria must exist for the auditor to be held liable for negligence under common law. What does negligence mean? Negligence means some act or omission which occurred because the person concerned, that is the auditor, failed to exercise that degree of reasonable skill and care which is reasonable to be expected in the circumstance of the case. what is considered reasonable is basically not what a super careful and expert auditor would do, but rather what an ordinarily skillful person will do in that circumstance. So what that means is if you bring together qualified auditors, say 5 of them, and say do this, more than half should be able to agree with what you've done as being the right thing to do. If more than half agrees with you with what you did, that this is what should ordinarily be done, then you can be said to have exercised what? Reasonable care. If less than half agree with you or feel that it should have been done to the extra step that should have been undertaken, then you can be said to have been what? Negligent. So this is the first situation or condition under which an auditor might be what? Negligent. Under what? Common law, customs, precedent, based on what's been happening before now. A second bracket or group or situation where an auditor might be liable is called what? Liability under what? Contract law. Now, when an auditor is appointed, there is a letter called what? A letter of what? Engagement, which outlines the responsibility of the auditor, the responsibility of management, what's expected from the audit, and then the auditor signs off, and then the company also signs off. Now that letter, once it signs off, becomes what? A legally binding contract. And like every other contract, once a party fails to comply with the terms of that contract, the other party has the right to sue that party to court, and the party will be liable for not meeting the terms of what? Of that agreement. So just take for instance a normal agreement for accommodation of an apartment. You have a contract and you say, I'm paying you this amount to be in your apartment for 1 year. Now, as the owner of that apartment, you are liable to meet, you're expected to meet, to keep to the terms of that agreement. So you can't just come to the tenant and say, please vacate when it's not a year, without being liable for it by paying some level of compensation or something. So it is with auditor's liability on that contract. When that contract has been signed, the auditor is liable. Now, the terms of the contract which an auditor is liable can be expressly stated or what? Implied. Statutory audit is mandated by company law, which prescribes the auditor's duties, responsibilities, and rights, and expresses terms of the audit contract. And express terms of the audit contract cannot override the statutory provision. So basically what we're saying is that, remember that we've discussed some laws that guide audits and financial reporting by companies. You know, we've discussed requirements such as CAMA, we've expressed requirements such as requirement of FRC, we've discussed such as BOFIA if it's a bank, we've discussed Insurance Act as well. Now, these different laws have spelled out some duties, some rights, some responsibilities of auditor. So regardless of what is stated in the contract of your letter of engagement between the audit firm and the company you're auditing, these duties, these rights are part of it, implied by entering into that contract, regardless of whether it is stated expressly or not. So that's what we mean by what? Terms of the contract being what? Implied. So the implied terms which the law will impute into the audit contract are as follows. So these are some of the implied terms. 1, auditors have a duty to exercise reasonable care. So even if it's not stated in that letter that you should exercise reasonable care, you have a duty as an auditor to do that. And you are what? You are liable. 2, the auditors have a duty to carry out the work required with reasonable expediency. And 3, the auditors have a right to reasonable remuneration. So these are the requirements. A third group is liability under statutory liability, what's called statutory liability. In other words, what is stated in the law. Statutory refers to law. So what's stated in the law? So auditors may be liable for financial damages in respect of civil offenses and conducts that are inappropriate and for breach of trust. This would normally happen when the auditors have misused their position of authority for personal gain, such as where a company suffers loss or damage as a result of the failure of its directors to discharge the fiduciary duty imposed on them to perform the job with due care, diligence, and skills. The auditor shall be liable for negligence, and directors may institute an action for negligence against him in the court. And so failure by the auditor to discharge his work, what is responsibility with due care, the directors can sue them for negligence. What if the directors do not do that? Any member may do so after the expiration of 30 days notice to the company of his intention to institute such an action. So the first responsibility or duty falls to the directors. So the directors are expected, they are required to do what? Institute a court action where it is determined or suspected that the auditor was negligent. If they fail to do that, any member of the company may do so. But before they do that, they need to first what? Give a notice to the company of their intention and give them what? 30 days notice. So basically that 30 days notice gives the directors an open window to decide, to make a decision as to going ahead with the court action against the auditor. For a company that is in the process of winding up, the auditor may be liable as an officer of the company, and if found guilty, he may be required to contribute to the extent of the loss arising from the breach of trust. So if the company is winding off because we are negligent, because the conduct of your duty, then you are liable as well to part of the loss reported therein. The fourth group of liability is what is called criminal liability. Criminal liability. So where an auditor makes a misleading statement or falsifies records with the intent of deceiving. Please take note of that. With the intent of deceiving, such an auditor may face criminal liability and on conviction be liable to imprisonment or fines or what? Both. So if an auditor makes a statement or issues a report, knows that that report is false, but still goes ahead to issue that report, is liable as a what? As a criminal. So he's subjected to what? Criminal liability. However, if the auditor is just merely negligent in the conduct of his duty, he didn't do what he's meant to do, and as a result, loss is suffered, the auditor is liable under civil law. So please take note of the difference between civil liability and criminal liability. So criminal liability will be intentional. Civil liability will be what? Non-intentional, but you're just negligent in the conduct of your duty. So what of the promoters or directors of a company? If any promoter, director, or officer, or an auditor of any company makes, circulates, or publishes, or concurs in the making of any information or account which he knows to be false, such an officer is what? He has committed what? A criminal offense and shall be guilty of felony and liable to an imprisonment of 7 years. So These are situations under which an auditor can be held liable for their what? For their action. Negligent. So that means that as an auditor, you need to conduct your work, your duty with what? Reasonable care. What is that? Reasonable care. Reasonable care does not mean that you are infallible. No, but rather it means that you've carried out the what is expected from every auditor, a reasonable ordinary auditor. So if you bring together 6 auditors and say, how would you perform this? More than half would agree with what you've done. If less than half agreed with what you've done, then to a high degree it can be said that you are negligent in the conduct of your responsibility. So what have we considered in this session? 1, the auditor, by virtue of his appointment and the course of executing his assignment, should demonstrate some professional skills and competence. 2, upholding requisite professional ethics, competence, fairness, due care, objectivity, and independence are some of the requirements for auditors. So we discussed it extensively or when we talked about the code of ethics for auditors. 3, auditors can incur liability under common law. So common law would be based on custom, laws that derive from custom, from practices, from precedents. Under company law, under law of contract, based on the contract that the auditors entered into with the audit client, and Nigerian criminal code, if he does not exercise care and diligence in the performance of his duties. So it becomes a crime if the auditor did that or issued that statement what? Knowingly. Auditor issued the statement knowingly with the intent to deceive, then it becomes what? A crime or a criminal offense. So auditors can be held liable if they are negligent in the conduct of their duties, and then those who rely on that financial statement suffered loss from relying on that statement. So let's recap using practice questions. So we'll look at a few multiple choice questions and then short answer questions as well. Question 1. So just try and attempt these questions. You could pause the screen, attempt them, and then we'll display the answers at the end of it. Question 1. Which of the following is not an objective of auditing standards and guidelines? A, to minimize engagement risk. B, to ensure quality control on audit. C, to enhance the initiative of the auditor. D, to ensure uniformity in carrying out audit assignment. D, to increase auditor's image in the eyes of the users of the financial statements. Question 2. The fundamental principles of professional conduct are as follows, except fundamental principles of professional conduct are as follows, except A, a member should behave with integrity in all professional and business relationships. B, members should strive for objectivity in all professional and business judgment. C, a member should not accept or perform work which he or she is not competent to undertake. D, a member should carry out his or her professional work with due skill, care, diligence, and expedition. E, a member should always obtain the advice and guidance of senior members in all professional engagement. Question 3. Which of the following is a safeguard created by the profession against threats to independence, objectivity, and integrity? A, continuing professional education requirement. B, a corporate governance structure. C, peer pressure towards integrity and objectivity. D, partners' high regard for your career and reputation. D, E, emphasis on integrity and objectivity as hallmark qualities. Question 4, according to the Professional Code of Conduct for members of ICAN, a member who discovers information which adversely affects account or statement that is currently preparing or audited should, what should the auditor do if he discovers an issue the account is auditing? A, stop work on it immediately. B, report to the police. C, qualify his report on the account. D, report to the tax office. E, resign his appointment as auditors and refund all fees already received for the exercise. Question 5. Which of the sanctions listed below is not imposed by the Institute of Chartered Accountants of Nigeria for misconduct of its members? A, reprimand. B, payment of cost. C, closure of practicing office of the members. D, suspension from membership. E, removal of name from membership register. 6, which of the following statements is false? A, an auditor may fail to exercise sufficient skill and care. B, the audit engagement is a contract. C, auditor could be imprisoned if he becomes criminally liable. D, an auditor is above all forms of liability under common law. And E, making a misleading statement could lead to criminal liability. 7, an auditor must exercise due professional care by A, obtaining professional experience and formal education. B, examining all available corroborating evidence. C, critically reviewing the judgment exercised at every level of supervision. D, reducing audit risk to the barest minimum. E, preventing fraud and irregularities. So these are short answer questions as well. You attempt this, you pause and attempt this. Where's question 6? Where standard or guideline issued by ICAN in Nigeria conflicts with that of IFAC standard or guideline, which should prevail? So that's take note of that. Next question: the way and manner each member is to relate to other members on the one hand, and to the society on the other hand, both from a formal perspective, is regulated by professional what? Next question: according to the Code of Ethics issued by IFAC, independence required both independence of and independence of. So there are two elements. If you remember, consider that, two elements, independence. Next question: a member may disclose confidential information to third parties in certain circumstances. Yes or no? Next question: according to ICAN Professional Code of Conduct and Guide for Members, honesty, fair dealing, and truthfulness implies, so what code is that? Next question: an act or omission which occurs because a person failed to exercise that degree of reasonable skill and care which is reasonably expected of him is called. Finally, when an auditor is found negligent in the performance of his duty and the client suffers a loss as a result, the auditor will incur what and pay what? Okay, so hope you've attempted that. So get the answers. We compare this with what you have. I hope you were able to get all the answers correct. And if you're not, please take a moment to review the relevant section as we've covered all of these in our session today. Thank you very much for being a part of today's session. Look forward to having next session with you. Thank you.